Ever wondered what sets the Magnificent Seven stocks apart? Today, we're lifting the veil on their financial prowess. Our first destination, an in-depth analysis that kicks off our journey into understanding the extraordinary potential of these market giants. Price to free cash flow analysis. When scrutinizing stocks, one often relies on the market's conventional price to free cash flow ratio, which historically tends to fall within the 15 to 16 range. This ratio is a barometer of a company's valuation relative to its ability to generate free cash flow, representing a critical metric for investors assessing a company's financial robustness and operational efficiency. However, it's imperative to consider variations in this ratio, especially for companies in high-growth phases that yield substantial returns on invested capital. In such instances, a justification exists for a higher valuation, indicative of the market's confidence in the company's sustained growth and profitability potential. This concept underscores the dynamic nature of valuations, urging investors to navigate beyond static benchmarks and appreciate the nuances of each company's growth trajectory. Magnificent Seven Companies. Analysis. Directing our attention to the illustrious Magnificent Seven companies, Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Meta, reveals a collective price to free cash flow ratio of approximately 46. This figure suggests that these companies are currently assigned a premium valuation compared to the historical market average. Despite this elevated valuation, these companies collectively generated an impressive free cash flow of $275 billion in the last 12 months, maintaining a market capitalization consistently hovering around $11 trillion. This realization prompts a deeper analysis into whether the premium valuation aligns with the company's growth potential, revenue outlook, and their demonstrated capability to generate returns on invested capital. Additionally, scrutinizing the individual narratives of these companies becomes crucial in understanding the context behind their valuations. Investor versus speculator perspective. The distinction between investors and speculators is foundational to navigating the complexities of the stock market. Investors are akin to holistic strategists, skillfully weaving the narrative or story of a company with quantitative analysis. This nuanced perspective recognizes the vital importance of balancing qualitative facets, such as market positioning and growth prospects, with quantitative metrics like free cash flow. On the flip side, speculators tend to gravitate towards the narrative, often basing decisions on market sentiment and prevailing trends. This elucidation underscores the integral role of fusing the narrative with numerical analysis to foster well-informed investment decisions. By doing so, investors can develop a more comprehensive understanding of a company's intrinsic value and growth potential. Determining worth and future growth. Delving deeper into the factors that could potentially justify a higher price to free cash flow ratio unveils the critical role of assessing future growth. The analysis contemplates scenarios wherein a substantial increase in cash flow, such as a doubling to $550 billion, is anticipated. However, it emphasizes that the crux lies not only in envisioning this growth, but in evaluating its sustainability. This nuance adds a layer of complexity to the decision-making process, underscoring the delicate balance between paying a premium for companies with promising growth trajectories and avoiding overpayment based on overly optimistic assumptions. Essentially, this scenario-based approach calls for a comprehensive analysis of a company's strategic initiatives, market dynamics, and potential challenges on the horizon, providing a clearer picture of the company's potential future value. Investment philosophy and risk management. Acknowledging past investment mistakes, the discussion highlights a discernible shift in investment philosophy towards a willingness to pay a premium for companies demonstrating sustained and growing free cash flow. This transformation reflects a more cautious approach to risk management, recognizing the importance of creating long-term value. It underlines the imperative for investors to strike a balance between recognizing the intrinsic value of a company and avoiding excessive optimism in the face of growth potential. This evolution in investment philosophy aligns with the principles espoused by notable investors like Warren Buffett, emphasizing the importance of investing in high-quality businesses with a competitive advantage. The emphasis here is not merely on growth, but on sustainable and prudent growth that withstands the test of time. Before we uncover more financial gems, take a quick moment to show some love. If you're enjoying the insights so far, don't forget to hit the like button and smash that subscribe for more valuable content. Your support means the world. Now, let's get back to decoding the financial universe of the Magnificent Seven stocks. Analysis of top 7 companies. Let's take a closer look at the 7 big companies: Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Meta. The overall picture shows that these companies are valued quite highly, with a combined price to free cash flow ratio of about 46. However, breaking it down reveals interesting details about each company. Consider Apple, a massive company with a market value of $2.8 trillion. It has a price to free cash flow ratio of 28, which is lower than the average, but this is because of its sheer size. Despite being enormous, Apple is still managing to maintain a good return on its capital. However, due to its size, it's challenging for Apple to reinvest at high rates. This challenges the usual expectations about valuation, as Apple proves that size doesn't always mean slower growth. Now, shift attention to Nvidia and Tesla, which have much higher price to free cash flow ratios, 110 and 120 respectively. This means the market is placing a big bet on their growth potential. The interesting part is that these companies, expected to grow the fastest, have the steepest valuations. This raises questions about whether the market is accurately pricing in the anticipated growth. Going beyond the numbers, it's crucial to understand that free cash flow is like a company's lifeblood. It's not just a metric, it represents how much money a company has after covering its expenses and investments. This leftover cash is vital. Companies can use it to buy back their own shares, pay off debts, invest in new projects, or distribute dividends to shareholders. To make sense of all this data, tools like the Stock Analyzer come into play. This tool helps investors make more informed decisions by projecting future cash flows based on different growth scenarios. It's like a guide, helping investors navigate through the complexities of valuations, growth prospects, and risks. In simple terms, analyzing these top companies goes beyond looking at numbers on the surface. It's like reading a story. Each company has its own narrative told through its financials. By combining the story with the numbers, investors get a better understanding of these tech giants. It's about looking beyond the surface, understanding what drives these companies, and making smarter investment choices. Balancing growth and valuation. The narrative articulates a meticulous approach to growth investments, recognizing the delicate equilibrium required between growth expectations and reasonable valuations. While the allure of companies with high growth potential is acknowledged, it underscores the importance of avoiding overpayment for this growth. This perspective aligns with the idea that, as an investor, one should be mindful of the trade-off between growth and valuation. By avoiding excessive optimism and conducting a thorough analysis, investors can make decisions that align with their risk tolerance and long-term investment objectives. The goal is not to shun growth, but to assess it critically within the context of a reasonable and justified valuation. Market perceptions and opportunities. The discussion delves into the dynamic nature of market perceptions and their profound impact on stock prices. It highlights the inherent tendency for narratives associated with companies to change based on market movements. An emphasis is placed on the need for patience and strategic decision-making, particularly when market fluctuations create opportunities. The text challenges the notion that investors genuinely desire stocks to fall, emphasizing that the market's reaction to falling prices often shapes the narrative around a company. This reinforces the importance of maintaining a patient and disciplined approach to investing, seizing opportunities when the market misprices stocks based on temporary sentiments. As the discussion concludes, the text reflects on the justifiability of a 40 times free cash flow valuation for the top companies. It underscores the necessity for reasonable assumptions, emphasizing that investment decisions are inherently forward-looking and involve making informed predictions about the future. The role of patience in waiting for the right opportunities is reiterated, aligning with the idea that successful investing requires a combination of quantitative analysis, an understanding of market dynamics, and a disciplined approach to risk management. The notion of making assumptions about the future is acknowledged, stressing the importance of doing so within a framework that balances optimism with prudence. Thanks for joining this deep dive into the financial universe of the Magnificent Seven stocks. If you found value in our exploration, don't forget to hit that like button, subscribe for more insightful content, and ring that notification bell. Until next time, happy investing.